We're going to be speaking about trading journals today in this installment of Ultimate Options. And Corey, you were instrumental in this simply because you built this trading journal. This is worth thousands of dollars, and you'll spend hundreds to buy one of these to get the value of thousands. I'll tell you what. So, as always, I appreciate you joining me in this class, and we're going to do the most detailed class. We've done a couple that we've put on the site for reference on Trading Journal. This one, we want to do the best one we've ever done. So thanks for coming, Corey. And
yeah,
also,
happy to be here. And tracking performance, using a journal and tracking your performance allows you to really see how you're doing and how the process is going. So very important stuff.
It is important stuff. And so we go, I would be remiss if I didn't do this right here. And that's to put in a disclaimer at the top instead of the bottom. So let's get back here and keep it rolling. Okay, so let's talk a little bit about, first let's do the disclaimer. We're here to educate, not here to recommend, and we have risk. And part of managing that risk is we want to always record at a minimum. Now, you could do a trading journal where we said, okay, I do X, Y, Z stock. I have a quantity of 100 shares right here. And I have a target price of, 206 and an entry price of 200 and exit price of, 198. My risk right here is $2. My reward is $6. So I have a reward ratio of 1 to 3, and I have a probability of 50-50 up or down or whatever you want to say. So just writing this stuff out helps you trade better. Why?
Yeah, when you keep track of that, you're able to quantify and understand where you sit in the trade. So it sounds logical that we wouldn't put on a trade unless we felt like the risk and reward and probability was all shaping up really well, but you'd actually be surprised. Some people will get sucked into the market because they're sitting there watching CNBC and they just take action. And then they think, well, wait a second, what am I doing with this stock? When do I get in? When do I get out? They don't even have a game plan, So it kind of seems obvious when you talk about it in these terms, but actually a lot of people involved in the markets are not thinking in these terms. They're just reactionary to the markets. And so we always want to quantify that, and it comes back to expectancy. What an expectancy is if I do this over and over again over a long period of time, is it going to yield positive results? And we want a positive expectancy. When it's not the greatest example, but reality is that gambling, the casino has a positive expectancy. That doesn't mean they make money every night, but they do make money over time because they're using reward and risk and probability in their favor. There are some games where they're going to allow you to win more than you can lose. But because your probability is so low, they're still going to expect to make money on that game over time, So as traders, it's the same thing. We can get positive expectancy working in our favor, but we've got to be able to quantify this, track the results, and make sure we're on the right path, that this is generating positive expectancy over time.
When performance is measured, performance improves. We said that there were 6 basic positions, and then we get our complex trade out of these 6 positions. So what we're going to do is we're gonna go from cash to long stock, or cash to short stock, or cash to a short call, or cash to a short put. We're gonna put these positions on, and we're gonna learn how to do it in the trading journal. And then I'll also say this is we're gonna spend some time doing some complex trades. Now, a complex trade, this is important, so write this down in your notes, is going to have a net result to it. And the 2 types of results you can have when the trade is built is you can have a net credit when you're all done, and you can have a net debit when you're done. Okay, and we're going to be doing all kinds of these. Now, what the word net means is when it's all said and done. when it's all said and done. For example, if I have this guy here and this guy here, and this guy makes a promise he's going to get paid, right? And this guy now has a choice. So maybe this is a call and we send the premium that way, make a promise, get paid. So this is going to be a short call where this guy right here has made a promise, right, to sell this option to this guy. Okay, this is us. This is you and me. You, me, and Corey right here. So money would go this way. But if he wants to get the long stock, there's another transaction that goes on with stock where I say, I want to buy the stock now, beforehand. I want to buy stock now so I can keep my promise. So I don't have to worry about it. So I want to buy the stock first. You don't have to buy the stock first, but it's safer if you do. And so I have money going out this way. Okay, this guy says, I want to sell stock, whoever this guy is. So I want to buy stock, I want to sell stock. So if I spend more money on buying the stock and I do all of this in one transaction, okay? This would be called a covered call. If I do this in one transaction, my net result is I'm sending out 3, 1, 2, 3 are going away, right? And I'm bringing in 1, so I get to bring in 1. My net is going to be a net of 2 cents away. So this is called a net debit. And I can enter in the trading journal either way. I can do both transactions individually, but what most of us will wind up doing, and what we're going to do in this course, is combine those transactions to just get a net result, because the combination of this call being out there and this long stock being out there, we're either going to get out of those positions for a profit or get out of those positions for a loss or a break even. And so it's really the net that we're after. In this case, this would be a net debit. Any comments on that?
Yeah. Whenever more money is going out, like Andy has shown there, it's a net debit. Whenever a net amount is coming in, so if we had flipped that and maybe we sold an option and bought another option, and the sold option paid us more money. So say we make a promise here and we collect, $3 signs or something like that for the promise that we make, and then we go ahead and we buy another option. So we send some money out, but we only pay a smaller amount on the one that we buy. That would be called a spread trade. That's a complex option trade where we sold one option, collecting a big credit. We bought a separate option for protective purposes or whatever that cost us a smaller amount of money. Notice that the net effect is now a credit. So we brought in more money than we paid out. We were credited cash, and that cash comes into your account immediately. So, in terms of this trade, we brought in 3, we paid out 1, so we have a net credit. And so we can enter that into the trading journal that way. Here was our net credit received. Here's our maximum potential gain. Here's our maximum potential risk. And what's really great about the journal is as you fill out the details, it will calculate your risk and your reward for you. It'll show it in terms of a reward to risk ratio and give you some metrics that way. So it actually simplifies the process as you learn how to put in the details of it.
So when we say complex, that might be complex, it might not be complex. Complex just means more than one of these, right? A complex trade would be where I might have a short put, a short call, and a long put, maybe in an iron condor or something. And the reason they call it complex is because there's more than one transaction going on. Here we had 2 transactions, one where we were the seller and got 3 in, one where we were the buyer and we sent 1 out. So this is us in both cases. Here we were the receiver of money, here we were the spender of money. So the result is a net credit to our account. These are my favorite, so we'll put a little heart by that. I love cash flow. I love doing those. And so I love trades where we receive money. So with that, we're going to get to the trading journal here. And to do that, watch this. Voila. there is the trading journal. And I'm going to actually give Corey mouse control because he's so better at navigating this than I am. And what we're going to do is we're going to do these one at a time. So the first one we're going to do is we're going to do a long stock. So I'm going to write that up here at the top. Okay, let's put it in blue. Long. Oh, let's put it in red. There we go. Long stock. So this will be an example of long stock and how to enter it in. So Corey's going to give a little overview of how to set this up, how it's been set up in paper. You absolutely want to practice this on paper, and every single strategy we do, we're going to start off, the first one we're going to start off with cash covered puts, but every strategy we do is going to take place in this trading journal. So we're going to go to the stock tab first down here, and then we're going to do a stock, and we're going to show how that affects things. So Corey, take it away.
All right. So like Andy said, we're going to be on the stock tab, and we're going to come up here, and you can put in your initial starting capital. This means how much money do you have in your brokerage account to trade for trading purposes? And you'll want to put that number in. We just have a hypothetical $50,000. Notice that they will give you, if you're in a margin account, they'll give you typically 2-to-1 margin. So you have up to $100,000 of buying power. But $50,000 of that is our money. And then we have, hypothetically here, a trading stop loss limit. And that's something that traders will use to kind of say, if things aren't going well, I need to kind of reassess things. And maybe I'll close off trades, and I'll take a couple of days off and make sure that I'm not part of the problem. Sometimes as traders, you're part of the issue. You know, anytime someone's going through a divorce or anything like that, they really shouldn't be trading because they're going to be in more of an emotional state. So we want to make sure that we have some loss limits where we say, okay, if I'm experiencing a drawdown, my account goes down, I'm just going to shut things down for a little bit, reassess, and then come back with a clear mind. Now, as we do that, we can put in the details of any trade. So we're going to start with the long stock. Well, a typical stock trade would acquire 100 shares. That's just a lot position, a round lot, right? So let's say that we buy 100 shares of stock. You put in your quantity. This stock can be any stock. It could be S&P 500, whatever you're trading, but we'll just call it ABC, right, for educational purposes. When you buy a stock, you have a cost basis. That means, where did you buy in? Now, we're not going to spend a lot of time right now talking about the technical reasons. Here's why you bought and why it was a good entry. We're just going to put in the details as if we were entering a trade. Well, we might buy the stock at $40 per share. So if you buy 100 shares at $40 per share, you have $4,000 invested in this particular trade, and we'll come back to that in a minute. When you enter a stock position, you normally want to have some ideas as far as your target and your stop loss. So let's say that we were targeting on this particular trade for this stock that we bought at $40 per share to go up to $44 per share. I'm going to set my target where I think this stock can trade to. And then I'm going to put my loss limit on this particular trade. If it goes down, remember what a stop is, stop me out if it's at this level, because I know that it's going the wrong direction, it's broken support, whatever it is, and maybe our stop loss is at $38 per share. You simply enter the details of your game plan. As you enter those pieces of information, and you could put the time you entered and the date and so forth, as you do that, you'll notice over here on the right-hand side, it already starts to spit out information for you. And it tells you right here that your ratio of reward to risk, we have a 2-to-1 ratio, meaning our reward is twice our risk. Now, let me show you where that number comes from, because you're going to see that with every trade we put in, and it will give you your reward to risk ratio. 2-to-1. Why? Because if we sell at our target of 44 and we bought at 40, we made $4 per share. If we sold at our stop out point at 38 versus our buy at 40, we lost $2 per share. If you're risking $2 and you have the potential to make $4, then your reward is twice your risk. That's simply your reward divided by your risk will be your reward to risk ratio. So we have a 2 ratio. Our reward is twice our risk. As we go, we can kind of tweak the numbers a little bit and show you some different examples where that reward to risk ratio could be higher or lower depending on the style of trade. The percentage at risk is telling you that, well, if you buy 100 shares at $40 per share, remember we said that's $4,000. $4,000 of a $50,000 account is 5%. So in terms of this trade, in terms of the percentages
Positions
and whatnot.
and the position size, right?
What's that?
And talk a little bit about position size.
Yeah, so in terms of this trade, and I actually said that wrong. The percentage risk, on this one, 5% is the amount that you're risking in this particular trade, which is $200, versus your $50,000 invested is your risk percentage. So in other words, we have $200 at risk versus our $400 of reward on the account size. But if you position size on this, $4,000 invested at $50,000, we'd actually have 8%, right? So we have about 8%, if I'm doing that right in my head, we have 8% of our money invested in this particular trade. Now, in terms of options, this is a stock trade, so it's typically going to require more of our capital. Options are going to give a lot of leverage, so you'll notice a difference where when we get into option trades, it will tie up a lot less of our capital per trade. In this case, we're tying up more of our capital. About 8% of our money is invested at $50,000 and $4,000. So you can see in terms of this trade, as we put in the exit details, it will give additional information. So let's say that we exit our 100 shares, and let's say that this one worked out and we hit our target of $44. Again, you can put on your exit date, and if there was any partial exits, you can put that in there. Once you do that, it's finalized. So now it kind of zeroes these out, and it says you achieved a $400 profit, right? We sold at our target. We had bought at 40 and sold at 44. So we made $400 of profit. Now, this number will show up in a couple of different places. If we come over here to stock comments, we can put in the details of this, and notice there's some details here. It says ABC, it has your entry details, and it has your exit price. And then you'd put in, this is a journal, so remember to put in details. What did you learn about this? What was kind of your thought process for getting in? What was your reason for exiting? What was the setup and the scenario?
Now,
were there any errors made? Any corrective actions that needed to be had? And then, was it profitable? And it automatically puts yes, because it shows that it was a profitable trade. I think this is a very valuable area to keep track of your thought process and whatnot. You can even mark here.
In the next segment, we're going to begin talking about criteria. And so in this segment where it says reason for entry, you're going to probably be listing, well, it fit this certain criteria. The broad market was X, I saw the stock here, the fundamentals were here, the technicals were here. I wanted cash flow, that's why I chose stock instead of option. And so we're going to give you criteria, and that's probably where it'll go, reasons for entry. Exit should be put, you can fill out this stuff before you get into the trade, the reason for entry. You can fill out your reasons for exit before you exit the trade, right? You should plan those things out beforehand. Then on your errors made and your notes of corrective act, if you make an error, you write down what your mistake is. And the only, it's like Robert Kiyosaki says, never waste a good mistake. If you lost money, then you say, okay, did I not have my exit criteria right? Did I not have this correct? And then put your notes in and says, okay, next time, this is what I learned. And that way it ensures that we learn from any mistake that we have.
Yep, great points.
Don't waste mistakes.
And then if you, yep, absolutely, 100%. Then if we come over here to stock summary, we only have one trade in the journal so far, but notice that it starts to tally your details. It says, okay, here's how we did on that trade so far, and it'll track them in groups of 25 and start to give you some graphs over here so you can see your equity growth curve and your profit and loss for each block. So here's how I did in the first 25, and here's how I did in the second 25. Here's your average profit per trade, and here's your win-loss ratio. And it's going to track all of that for you as you put in the details of these trades. It's really a great program that way for keeping you organized and allowing you to see information and kind of that's the idea behind a journal, right? That's why we write in a journal.
It's huge amount of hours to build this, and it's huge amount of smarts to be able to build this. So, a huge credit to Corey for sharing this, because this is not easy to do and not easy to build. And you'll notice if you go back to the first stock tab on the bottom, Corey, that we've got this. We're looking at this. Corey has set this up at 25 trades at a time. So you do 25 trades at a time. Your first 25, your second 25, your third 25. And it's a great time to say, not get caught up in just one trade as you see how this works out. So as you go back to the stock summary and you see those graphs beginning to be built, you'll be able to see your progress of how it worked with the first 25 to 50, or 26 to 50, 51 to 75, and so forth.
Yeah, and your first 100, 200, whatever, should be paper trades. You should be putting your paper trades into this journal and really tracking the results. And any errors that are made, they should be while you're in the paper trading platform. So use this journal, for live trading, for paper trading, for all of that. It's intended to be educational as well.
Yep.
That's really the purpose of this journal, is so that you learn. It's not so, all of this, let me put it this way. All of your trade details, they're tracked at your broker. And at the end of the year, you can print off a statement. You can print off monthly, daily statements. You can get all the information. But what you can't get is all of the
learning,
kind of your thought process during that trade, what you learned from it, what you did well. Try to keep duplicating those successes. So that's the idea behind a journal, is to have, there's a great saying in trading, plan your trade, then trade your plan. Yep. Go in with a game plan and then follow that plan through to fruition. So that's the idea behind creating this. Let's do a short stock, shall we?
Let's write down short stock so we know which one we're working on now. And really, you leave that in there and just, tweak some numbers, really, but let's do it.
Yeah, you could do that.
Let's do a short underneath, though. Let's do a short underneath.
Let's do it. So we start to track some things.
Let's short 100 shares of XYZ.
Love it. We're going to short XYZ, and maybe this is a little higher price stock. Maybe we shorted this baby at $80 per share, something like that. And we can put in our date and our time. And then here's a little box. You'll notice it has a short box, and you just simply put an X right there. Now, when you do that, that tells the journal to calculate this the other way, right? It now knows that you're profiting as the stock price goes down, you're losing as the stock price goes up. So anytime you short,
you can build
just put the X.
You can build one of these spreadsheets by yourself if you want, but I'm telling you, it's a boatload of work to have it done for you. So that's pretty awesome, Corey. That's a lot of I'm just saying there's a lot of calculations going behind the scenes, a lot of functions here.
No doubt. So $80 is our entry price. We're targeting, maybe in this one, we think that stock's going to go down to $75 per share. And we can put a little bit, wacky, a little more wacky number where we say 82. So that'll give us a little different reward to risk ratio, right? So now I'm shorting the stock at $80 per share. If I short the stock, I want it to go down. My target for maybe taking some profits is at 75. I'm going to stop out. If this trade isn't working, I've got my protective buy stop up above that will automatically get me out if this stock ever trades up to 82. I don't want that to happen, but that's my protection. Now notice the reward to risk ratio is a different number. 2.5. So this reward is even greater than our risk. Well,
Yep.
we can do that math in our head. We can say, if you sell something at 80 and you buy it back at 75, you're going to make $5.
Yep.
So you have the potential to make 5 in this. If you sell something at 80 and you have to buy it back at a loss at 82, you're going to lose 2. If you can make 5 and you're risking 2, 5 divided by 2 is 2.5. So our reward is 2.5 times larger than our risk in this example. And so you can kind of see the information there. Now we come over and we put in our exit details. And let's say that this one worked, but maybe we took it off even beyond our target. Maybe we started to trail the stop.
It dropped like a rock, okay? Something bad happened. We got lucky.
Yep. So it started falling, and we just said, you know what? I'm going to let this baby fall, and I'm going to start trailing my stop. And we got stopped out at a gain at 72. So I sold the shares at 80, and I bought them back at 72. How much money did I make on my 100 shares? Well, if you buy at 72 and you sold at 80, even though you did it in reverse order, you sold first, you bought second, we made $800, and it is the difference there, right? That's our profit. So just because our initial reward we were looking at was 5, doesn't mean we can't make more than that. And this is a very good example where this thing was moving in our favor. We just start trailing our stop and we say, let's let this baby fall as much as it can. Well, we get out at an $800 profit. Once again, you're going to come over here, and before this trade was done, you definitely have your reasons for entry in here. And you're going to come in and you're going to put your reasons for exit. And you're going to say, this thing was falling. We started to trail our stop loss using this approach. Were we profitable? Yes. Did we do everything right? Yeah. No errors on this one, no corrective action. This one worked as planned, and we managed it really well. So sometimes there will be maybe even something that you want to remember that you did really well. Hey, let's remind ourselves that this approach really tends to work. So let's trail that stop when something's really moving in our favor, or whatever that may be.
Now, as an individual, you have a decision to make right now. You have a decision to make. You can start this journey off the right way or the wrong way. Picture and imagine this for a moment. Picture and imagine that you decide on your first 200 trades, that you're going to use this journal. You're going to track it. You're not going to get lazy. You're not going to say, you're going to develop a habit, okay? A little habit stack of, when you do one habit, you attach another one to it, okay? It's habit stacking or goal stacking, one habit. So as soon as I enter the trade, I go to my trading journal. That's the 1-2 punch habit. And just picture, you can do this 2 ways. You can either use the trading journal or not. Picture this trading journal full. Picture it being totally full, and the wealth of information you'll have of corrective action each time at the very end, and how nice that will be. You see that? And so this is, again, every single time there's just certain things we're going to cover before you get to trade the option that make a huge difference in what type of trader you'll be. Think about this. You can either be a person that did your first 200 trades in a journal or your first 100 trades out of a journal. Which one is going to make you more successful? That's the decision you can make right now for yourself. Which one do you want to be? Are you excited about having this tool? Is this going to organize you? Is this going to be fun to learn from? I think it will be.
Yeah. Which business would you rather invest in? Would you rather invest in a business that's tracking their performance and tracking their results and their expenses, or the business that's not paying any attention to it? And so I think that's a great point. You get to decide which type of trader you want to be. And then over here, you'll notice our summary. We're still in our first 25 trades. We've got $1,200 of profit so far. First 2 trades working out pretty well. Maybe trade number 3 will be a loser. We'll see. We come back over here and we're ready for trade number 3, which we were going to do a covered call example. So let's put that in there.
Okay, so with the covered call, we're going to have let's do short stock, or let's go the options first, Corey, and let's do just the other 4. Yep, let's do all 4. So we have the basic 6 trades. So we got long stock, We got short stock. Now let's do a long call.
I'm going to click over. I'm going to click over to our option tab.
As soon as I give you back the pin.
Yep, no worries.
It's all yours.
Okay, so we'll jump over to our option tab. And as we do that, we're going to do the long call. Now, this will go under your option tab because you're now trading options, not stock. And the calculator, this trading journal knows, okay, now we're going to calculate things in this manner. So now, as we come over to our options, you'll notice your current account value is actually increased by $1,200. Kind of cool, right? Yep. We've got some profits in our pocket. Well, maybe we're going to trade some options, and we're going to trade on Acme, right? So we think this stock is going to go higher, and we might say, as a call option buyer, I don't want a lot of theta working against me, so I'm going to buy a few months out. Maybe it's the summer months or something, and we decide to buy September or October or something. We're going to give ourselves a few months' time, and you'd put the year in there and so forth. And this is just, again, to track your performance. So just keeping the details, essentially. So we might buy the September, and maybe Acme is trading at $60 per share, and we're going to buy slightly in the money. Maybe we're going to buy a $57.50 strike price on the calls. So we're going to buy it slightly in the money, just a little below where the stock is. That'll give us a little higher delta. We're not going to short this, so we're going to leave that short box open, but we are trading the calls. So I'm going to put an X right there, and then I'm going to come over to share. And
this is important. This is vital.
Yep, this is where you put in the information of the trade. Now remember, one option contract controls 100 shares of stock. So if I'm just buying one call option, I'm controlling 100 shares, right? So I put in my 100 shares that I'm controlling. If I had bought two call contracts, then I'd put in 200 shares right there, right? I'm just going to have it the same way that if I bought stock, I'd put in 200 shares if I bought 200 shares. Well, on the calls, one call contract controls 100 shares. So I put in 100 there. Now my call option might be going for, let's say, $4 per contract. So here's our entry price for the call option. When we pulled up the option chain, we saw, okay, the 57.50 calls are going for about $4 each. I bought one of those contracts, so I now control 100 shares of the stock at $4 cost. Now, in dollar terms, that's $400, and you can see it shows it over here, but we're going to get to that here in a second. We're just putting in the details. I'm controlling 100 shares at $4. Again, you can put in your date and your time. Now, maybe we have a target where we think that this call option is going to go up by 50% in value. Maybe we think it's going to go up to $6 per contract. And we're going to stop out on it if it drops to $3 per contract. If it's going the wrong direction, we'll go ahead and get out. Notice, once again, it gives you the same style of information. It tells you that your reward is 2 times greater than your risk. Because if you buy this option at 4 and you sell it for 6, you're going to make $2 per contract. But if you buy it at 4 and you stop out at 3, you're going to lose $1. Well, 2 reward, 1 risk. We have a 2-to-1 reward to risk ratio. It shows you that your risk in dollar terms is $100 and your reward in dollar terms is $200. Now, your commission over here, probably, you can put your tracking results. If I'm trading with Interactive Brokers and I trade one contract, it's only going to cost me a $1 commission.
Right.
If you're trading at Ameritrade or wherever, it might cost you, $3 or $4. But really good news, commissions have come down significantly.
You can trade
options.
Huge.
The competition, the option, there's never been a better time to trade in the options market than now. So you can put in whatever your commission is there. Well, our exit details. What do I exit? Well, I exit my control over those 100 shares. And let's say that we make money on this one, but we didn't make quite as much as we thought. It was kind of not going in our favor like we expected. So we got out of it early. for one reason or another. Maybe we trailed up a stop or whatnot, and we decided to get out at 5. We'd put in the details of that, date and time. And now notice over here, we have a $100 gain. It gives us our total. We made $100. Now it does actually subtract your commission for your total results. So we made $99 total. If we come over to our option comments, once again, we're going to be able to track this and say, what was my reason for entry? What was my reason for exit? And you know what? Maybe my reason for exit was that the stock just wasn't moving and earnings were coming out in 2 days or tomorrow. And I didn't want to trade this through earnings. That was not my goal. I wanted to be out before the earnings result. So I went ahead and took my profit. So I write down those details, right? I feel like, an error made was maybe my entry wasn't real well timed or something like that. I can kind of put in those details. And once again, it will track your results. So now as I come over to summary, we have our first of 25 option trades. It has our total at $99 profit and the details, and it'll start to track those in 25 trade blocks. So you put in those details and it kind of tracks as you go.
It's fantastic. Let's do a short call. I'll erase this and we'll put in a short call. So now we're going to do a short call, and we'll be halfway through the basic trades.
Love it. So now, as you can imagine, going to work very similarly, but remember, this is now a credit trade, and it'll know how to calculate that. When we get to the short box, we're going to click that short box, because credit trades, you hit the short box. Debit trades, where you're buying, you leave it empty. Okay, so maybe we're shorting in this one. We'll go back, and this is ABC again. And maybe we're using a shorter term option. Maybe it's June or something of such and such a year. We put in our strike price. Maybe this stock is trading at $90 per share, but we sell an out of the money. We sell a 95 strike short call. And we say, you know what? I don't think it's going above 95. I'm willing to short that call option. So I'm going to X the short, and I'm going to put an X in the call. And so now it knows how to calculate this. We're controlling 100 shares. And the call premium that it paid us, maybe it pays us $3.50 for that. So we put in those details. Now, our target, what do we want to have happen when we sell a call option, when we short it? Actually, our target is 0. We want that thing to expire. So we could put a target of, hopefully, we're able to allow this call to expire. We got paid our credit, our $350 up front. As long as this stock ends up below 95 at expiration, that call's going to expire. So we want to target 0 in this. We want the value of that call to drop. What's our stop? Well, maybe if it goes up to 5, we need to bail or make some sort of adjustment or something like that. Now we come over here and it shows our reward to risk ratio, still good, 2.33. So our reward is up to 350 is what we're targeting to make. And our risk is 150, the difference between where we're going to stop out and what we collected. So we will buy back that call if it gets to $5 or higher. We're going to close that trade out. And so notice we'll put in our, buy to close. We'll put in our exit detail. And maybe on this one we're going to take a loss. You know what? That stock started to go higher. We collected $350 for it. We decide it's time to buy it back at $5, and we're going to go ahead and exit that trade. And now it's going to show, and notice it turned into a loss. We locked in a $150 loss on that one. Again, you can kind of put in whatever your commission, track your expenses, and so on. And we put in those details. So we took a loss on that particular trade, that short call. We come over to our comments, and we can put in the details. And here's something kind of interesting is you might think the errors are only made on losing trades.
No, they're made on, Good point.
And errors can be made on profitable trades. And then you might think that every unprofitable trade must have an error, and that's not always the case. You know what? Sometimes your strategy was spot on, everything about it, but markets shift, markets change. All of a sudden something happens somewhere that wasn't expected. It can change the risk to reward of your trade and the probability of success. So sometimes you're going to say, you know what, I took a loss on this, but I didn't make any errors. I would take that trade again because normally that one will pay off.
That's worth thinking about for a minute. You might just sit for a moment and think about that for a minute. See, here's the problem. Stocks and options are forward-thinking instruments. In other words, we're always trying to predict the future. So we decide whether we made a mistake or not depending on our correctness in predicting the future. That's a really bad way to trade. Your correctness in the trade is, did it fit the criteria? Did I have an exit? And did I execute my plan? And I'll tell you, it's not about winning and losing. It's about whether or not you execute the plan. Your ability to predict the future is not a factor here, or we wouldn't need the fourth pillar, risk management. We're going to come to the table knowing, not thinking, not wondering, not even speculating. We're going to come to the table knowing that a market will shift the next day sometimes, that the market will change right after we put in the trade sometimes, with things beyond our control. That's not a mistake by you that you couldn't foresee a 9/11 or foresee a 2008 subprime meltdown. Seeing stuff like that it's hard to see. And so I love this comment you made, Corey, that often I think one of the trades in my life I was most proud of is I was in a short strangle. And those are like shooting fish in a barrel most of the time. Volatility crushes, get paid. And all of a sudden, this one gapped and ran. It gapped up and it started running. It started running big time. And so to do that, I had to delta hedge it. And I got out of that trade with a minimal loss. And it was a very difficult trade at that point in my career. It was one of the first times I'd really done it. And that trade at that point in my career was really an important trade for me because I was proud of it because I did everything right. And the market just did things that weren't expected. And so that's a real important comment, Corey, that just because you lost money doesn't mean you made a mistake. That's so good. That's so
right.
good.
That's right.
That so encapsulates the mentality you got to have. That's so good.
Yep, it is. And I would say the same thing. When I look back, the things that I'm most proud of are not that I made money, because making money, there are strategies, like you said, that are like shooting fish in a barrel. You can make money, but it's how do you handle the ones that are going against you? Are you willing to cut them off? And are you willing to make those kind of hard decisions in those critical moments where you say, you know what, this one's just not going as expected, and it's habit forming. The more you get used to that, and first it's in paper trading and then it's in real trading, being able to say, it's okay that I'm going to be wrong sometimes. That's part of what we sign up for. And to understand that's not personal. Everyone's going to be wrong sometimes. That's not personal, so don't take it personal. Just say, how am I going to handle that? How am I going to manage it?
Wait a minute, has your mother-in-law ever been wrong? Ever?
Yeah.
Ever?
Well, that's true. That's true. Some
come
people
on.
aren't wrong, but most of us.
No, if she's anything like your wife, she's wonderful. But you got it.
Sure.
You got it. I love what you said. It's what we sign up for. We're not going to predict the future perfectly every time. It's going to change on us. Hey, that's fine. We use our risk management to deal with that.
Yep. And no problem here. We come over here to our option summary, and guess what? We're in the red for a minute, right? We've got 2 trades on. Between the 2, we made some on one. We lost a little bit more on the other. So we're in the red a little bit, and that's what we as traders call a drawdown. That's nothing to panic over. And in fact, we're only down $50 so far over these 2 trades. But you managed your risk, you took it off when you were supposed to, you followed your plan. That's good trading. So let's come over, and now it's time for a long put, right?
And I'll tell you, that short call was the riskiest trade we've done here. I'll tell you what, that baby was risky. So now let's do a long put and see what that has to offer us.
All right. So we think in this case, XYZ is going to go down. So we're going to go out and buy, and let's say it's a different time of the year or whatever. Maybe this is a December option. And we would choose the strike price. And maybe this is a higher price stock. That's one of the benefits to options is we can access the markets on higher price stocks. So maybe this thing's trading at up in the 150 range. We're going to buy the 150 strike puts. So I'm not shorting it. I'm going long, but I'm going to X on the put because I'm buying that put option. So I'm going long the put. I'm buying it, expecting the value of that put to go up. Once again, we're controlling 100 shares of the stock. Now, you'll notice that there's kind of a typical relationship between how much options cost and their share price. If you think about why, this stock at 50 and 90 trade down here, but maybe this 150 strike put, maybe it costs us $8, $800.
Because you'd want a little time on a long put. You wouldn't want 1 month.
Yeah.
You want some time on this.
Exactly. You want some time to allow it to play out, and you're getting leverage over a more expensive share price. So you're controlling a larger value of stock, right? We're controlling at 100 shares control over a $150 stock. We're controlling $15,000 worth of stock
for $800
in this case. So, yep, for $800 exactly. Now we're targeting on this. We're putting $800 into the trade. Maybe we're expecting this option to go to $1,400 in value, $14 per contract. And we're going to stop out on this one if it drops to 6. So we say, okay, if it's not working, we're going to lose 2. If it is working, we're going to make 6. We have a 3-to-1 reward to risk ratio on that. We have $200 at risk, $600 of potential reward. And maybe this one's going in our favor.
Now I don't want people to freak out though before you put that in. See where it says risk reward potential information. See that 25% risk. Really reiterate what that number refers to because it's important to know what that percent risk is.
Yeah, so when you're looking at this in terms of percentages, you can say what is the percent at risk in this trade versus my percentage reward in the trade. And so where we have $6 of potential reward and $2 of potential risk, we're only risking 2 of the 8. Do you see what I mean? You're going to lose $2 of $8 invested, so that's 25% of it. You're of the contract of $800 at risk,
right.
We're going to stop it out when it's worth $600. So we're only risking 25% of the value of the option we bought. That's what that number shows.
Really important.
Once we put in our exit details, it will even take that away because now it's a realized, it's a finished product, right? But right now it's showing you're risking 25% of what you put in.
So
and it was the same thing over here on the stock.
Yeah. Show me the box. Now those are cleared out, but show me the box again so we get it. Let's go back to the option and let's really separate these ideas out. Is the risk there? Okay. And then the position size risk.
Yep. So we're risking 25% of just what we're buying the option for.
Right.
25% of the 800. But really, we're only risking $200. So if you think about it in terms of risk versus your capital, we're risking $200, but we have, $50,000 in the account. So $200 at risk of, divided by 50,000, we're only risking
0.4.
0.4. So less than 1% is total at risk. It's about half of 1%. And so this will maybe demonstrate it a little easier. And I should have maybe spent a little bit more time on it. Let's just say we were going to do another, or actually we can just clear this out so it's not a finished product. So let's just take this back to 0. And you'll notice the same thing here where it says, okay, if you buy the stock 100 shares at 40, you've bought $4,000 worth of stock, right?
Mhm.
That's your investment. If you stop out at 38, you've lost $200 of 4,000 invested. So you know you have $200 at risk. You're buying 100 shares at 40, you're stopping out at 38, so you have $200 at risk, and you've invested 4,000. Well, 200 divided by 4,000 is 5%. And notice over here it shows you're risking 5% of the total value of the stock that you bought. Okay, that's not your portfolio risk. That's the amount of risk in the total invested capital, right? And so, in terms of that every time you put it in, it will show you how much you have at risk. And then once you put in your exit details, of course, now it's a finished product. It's done. So you'll see that happen. So as we come in here and put in our exit details, hey, we bought those puts at 8. This thing's running in our favor, and it goes past our target of 14. Maybe we take it off when it's worth 16. So we doubled our money. We bought the option for $800. We sold it for $1,600. We made an $800 profit. So we made an even better than our 3-to-1 reward to risk that we were targeting. Whatever your commission is, again, you can kind of fill that out as you get more information on what your broker is going to charge per contract. Over here on our option comments, we put in our reason for entry, reason for exit. It was a profitable trade, so it tracks that for us. We come over to our summary, and now we've got 3 trades in there, and we're profitable, and it tells us our average income. When we make a profit, our average income is $450 a profit. When we lose, our average expense right now is at $150, and that's one trade. And here's our total. We're up for $747 total across those 3 trades. So
kinda
really
nice.
cool stuff.
Really kind of nice. Shows me how often I win, how often I lose. Let's do real quick. Let's do 2 more. Let's do a let's see. We got to do a short put, right? Real quick, and then let's do a combination trade. So we know what we're doing there.
Yep. So a short put. Maybe we like. Let's just say
CNA, Corey and Andy.
I love it.
Or can.
It switched it on us, but we'll do can.
Yep.
All right. And, maybe this is a January time frame. Again, you're just so you can track it. And on this one, we are shorting the put, and maybe we're saying, you know what, I don't think this stock's going to go below $50 per share. That's the strike price. And because we're shorting, it's a credit trade. We're making a promise. We're selling the put. So I'm going to click the short box, and I'm going to put an X in the put box. We're shorting the put, and that means we collected a credit. Now, once you put short right here, it knows to calculate that you're collecting the income up front, that you're getting a credit for this trade. Again, we're going to control, let's change it up. Maybe we sell this on 200 shares, whatever. And we collect $2 per contract. So I'm just going to get a little tiny bit more complex. Now we're selling 2 put contracts. So we're making a promise to buy 200 shares of stock, and we collected $2 per contract. So $200 times 2 is $400 of potential reward or income. In this particular case, what's our target? Well, we hope it goes to 0, expires. Our promise goes away, and we get to keep the income and that original credit. But you know what? If it's not working and it goes to 3 in value, maybe we're going to buy that baby back. And so we say, and notice here's your reward to risk. We're going to make 2 times what our risk is. Well, we end up buying those shares back. Actually, we'll make it again, another little complex thing here. You could do a partial exit if you wanted. You had a partial exit first. Okay, and so you could put that in. You took off part of it at 3. And then, maybe on the other half, we broke even. and we took it off at 2. So now you have details of you took one of them off at $2 per contract, so you broke even. That's what you collected, and you bought it back. But you bought the other one back at 3, and you kept your loss contained. So really, you only lost $100, right? Because you bought back one for a $1 price higher than where you sold it, and the other one you broke even.
Yep.
So here's your $100 loss. Okay. Again, your commission, you traded 2 contracts. Maybe you have, whatever. Maybe your broker charges $5. Doesn't really matter. Put in that detail and just make sure you're tracking those details. Once again, you'd come over, you'd fill out your comments. You'd fill out the summary takes care of itself. And now you're seeing, okay, average expense went up a little bit because we took a little bit of a loss on that one. Average income's there. And here's our total amount of profit. Still tracking our results quite nicely.
Now, I don't want to spend too much time on this because we're going to do this every time we do a trade, right, Corey? Every time we do a trade, we're going to show how it's entered in the trading journal. So, but it's good to get it downloaded first, to get clicking around in it so you're a little faster. So when we do this, it's not the first time you've seen it, and so you're ready to trade. Let's do one complex option, and let's show what it would look like separately and then what it would look like combined. Because you could do it either way. It's probably better to do it combined in terms of your notes and your trade. And so let's do a spread trade. Okay. And do you want to do a debit or credit?
Either one.
Let's do it. Let's do a credit. Those are my favorite.
Love it.
So let me draw what the trade looks like first. We're going to have 2 trades. So this is you right here, and this is, some dude over here, whoever he is or she. And what you're going to do is you're going to make a promise. And you're going to receive a nice chunk of money. And then this person here has a choice. Okay, and then we're going to come over here, and this time you're going to be standing over on this side, and you're going to buy the choice. And this guy will make the promise. You're going to buy the choice. And so you're going to send money him, but you're only going to send him that much. So when we add these trades together, right, this trade plus this trade means 2 were brought to us, 1 was taken away from us, so the net result would be 1. If we brought in 3 and only took back 1, then the net result would be 2. If we brought in 4 and spent 2, the net result would be 2. If we brought in 5 and only 2, the net result would be 3. Do you see that? So depending on how much money we can bring in and how much money we spend depends on if we get a debit or credit. Well, this is positive number, right? We received this, came to us. Here it went away from us, so this is a credit to our account. It's a positive number. It's a credit to our account. So let's take us through where we would enter this one first and this one second using these numbers here and here. In other words, I'd bring in a lot of money one, and then let's do it again where, no, we're going to go ahead and just go with this number, and it's just 1. So let's hop into that.
Perfect. And so, like you said, I like to combine the 2, but let's show you what they would look like separate. So you just make 2 separate lines, and it would be on the same stock. So let's say, in this case, it's you, me, and Andy.
Nice.
almost YMCA.
Yuma.
And maybe this is an August time frame, and maybe the option that we're selling, maybe this could be a bear call or a bull put. We'll get into those, and maybe this one's a bear call, we'll say. So we're going to sell the 100 strike calls. Stock's trading down in the 90s, and we're saying we don't think it's going to get to 100. So I'm going to short that 100 strike call. And so I click the box to short it. I X in the box that it's a call option. And I'm controlling, or I'm making a promise over 100 shares. We're just doing one contract. And we're collecting a large credit. Let's let's say $6. Okay, $6 for selling that one. And we put in here, well, we want that one to trade to 0. And again, you can put in some targets and whatnot. This will be easier when we do it as a spread, but let's put in some ideas. And then I'm going to skip the exit details and whatnot for now. Now we'd come over here and we'd do a separate line because we also at the same time bought a protective position. We wanted to make sure that this was a spread trade. And what that means is we wanted to have limited amount of risk and limited amount of reward. So we're going to go, I had my caps lock on there, sorry. So we're going to go August, and we're going to buy the 105 strike. And in this case, that's the one we're buying. It's a call to control 100 shares. And maybe this one cost us $3, or something like that. Now, in this case, again, it kind of works better when you combine them, but maybe our target is 5 and, stop out at 1 or something like that. We'll get to that. So we have our risk and reward on that particular one. Here's why it's kind of tricky is if we do them separately, then your mind starts to think, well, I'm trying to make money on this option and I'm trying to make money on that option. And that's not really accurate.
One's insurance. I'm not trying to make money on my car insurance because I don't want to wreck my car, right?
That's right. And so we're really not looking at these individually. We're looking at the sum of the two, right? And so, we'd have our commission over here and we'll put in some exit details and whatnot. Whoops. So let's go something like this. Now, here's where, again, I like to combine the two. So if I come over here and let's do it. There we go. Let's do it instead of on separate lines. Let's build it together.
Yeah.
So YMA August, and this is a spread trade. So I can just simply put in the details of both. I'm going to say 100 slash,
105.
105. Okay. Now I'm just telling it for tracking purposes, I'm trading the 100-105 spread. And I'm shorting that spread
because it's a net
it's a
credit.
Call, because it's a net credit.
Now the way to know whether to put the short in is think about it. I have one short position, one long position, but which one is bigger? Which one brings in more money? Well, as you look at the previous one, the short position is bringing in 6, and the long position is only costing me 3. So this is more short than long. In other words, if the short part of the trade and the long part of the trade were to arm wrestle, the short part has more power. So overall, I'm net short. I'm more. I brought in more money with the short than I brought in with the long. So I can put them both in, and the net result is a net short. Okay, I'm more short than long. I'm selling this, not buying it.
Exactly right. And so when you collect a net credit, you're going to X that box. And in this case, it's just over 100 shares. Now, you might say, well, I've got 2 contracts here. Yes, but they both control 100 shares. You're short that one and long that one for protection. So you're still only in one contract of this spread. You're still only controlling 100 shares. You're just making a promise at 100 and then covering your assets at 105. You're saying, I have my insurance in case this thing goes up. Well, what's our net credit? If we collected 6 and we paid out 3, then our net credit that we got for this was $3.
It's going to be 3.
Much easier to track this way. Now, notice it already shows us that our max reward on this is $300. So that's the most we can make in this particular trade. Now, as I come in here, what do we want to have happen? We're targeting this to go to 0. We're short the spread. So what we want is for our promise to go away. And we want our insurance to go away. We don't buy car insurance because we want our car to wreck, or or life insurance because we want to die. We don't want that. It's just to cover our worst case scenario. And that's the only reason we bought the 105s. And that's why it's much easier to build it in just one line, because that 105 is a throwaway option. We want it to go away. Even though we paid $3 for it, it's the $6 that matters. I will collect 6 and pay you 3 all day long. I'm perfectly happy to do that.
Yeah.
So the 3 I'm not worried about, it's the 6, right? And that's what we've done. We've collected a net of $3. Well, our stop out, you could say, what's your max risk? In this case, that could be our stop out point, where we say, if I collected a $3 credit on a $5 spread, you have a max loss already built into the trade.
Right.
$5 is your max loss minus the credit received. So on any of the credit spreads that we'll teach you, be it a bear call, which is this example, or a bull put, you can simply take the spread amount minus your credit, represents your max loss. So our stop out point is at 5. That's the most we can lose. Well, 5 minus the credit of 3 shows us that we can lose $2. So our reward to risk is 1.5. We can make 3 and we're risking 2. So our reward is 1.5 times our risk. For every $100 at risk, in other words, we can make 150, or in other words, $300 of potential profit for $200 of total risk.
Fantastic.
Now we put in the exit details here hypothetically, and maybe this thing expires. So good for us. We get to let this thing expire, and we made our $300 of profit.
Right, fantastic. There.
So, yep.
So that's options. Now, don't worry, because you've done 7 of these now, and 9 if you count the other 2. But the most important thing was to get you familiar with this, so it wouldn't be the first time. When we get into the option strategy, it's going to be enough to remember without having to learn this too. So just the fact that you've been here before, you've seen it, and you're comfortable with it is going to make you much, much better. Did you start with a trading journal, or did this come into your life later?
No, I didn't. And journals have evolved over time in that, my first journal that was created was very basic. In fact, I actually used to use a notebook and just write down, and we used to do all our risk graphs in a notebook, that sort of thing. And technology's come along to where first it was a basic journal, and then it's become a little bit more advanced, where we've put in more details and been able to add things about commentary and track our results. And so we're happy to share that journal with you. I'm happy to do it.
And you should be proud of it. It's a great journal. And it helps us understand it really helps define what our worst case scenarios can be. It helps us really think about what percentage of our portfolio we're putting at risk. It just helps us define that stuff. So download the journal and practice using the journal with every strategy we cover. We're going to cover stuff with Acme. We're going to cover stuff with ABC. We're going to cover stuff with XYZ. Your opportunity is to go in at whatever time you are in your trading and go find some stocks and practice the stuff. I also will give a plug to the Mentor Club, because that's another great place to practice the trading journal with stocks that are current. The moment you do a class, the class is there. And so if you want to get real good live examples, start doing Mentor Club a little bit. So that's huge. This will help you a little bit with your emotions. You said, Corey, to plan the trade and then trade the plan. If you plan the trade and trade the plan, all the decisions are made regardless of how you feel. So it won't eliminate your emotions, but it'll help you insulate yourself from them. Everyone is happy when they make money. Everyone is sad when they lose money. But if you plan this out in the journal and plan all these things out, well, now you're bound to the plan regardless of how you feel. So it really helps get rid of the impact, or at least reduce some of the impact emotions have on this. And then finally, make this a habit. What the goal stacking technique is when you add a habit you want to one you already have. So, for example, there's a great TED Talk by a guy who said every time he decided he had to use the bathroom, when he came out, he said he was going to do a push-up. And then you start with 1, then you do 5 and whatever. And, he's accumulated all these push-ups. Maybe another thing you do is, you floss your teeth a certain way and then you go do something else. So stack this. As soon as you make a trade, the next habit, that's a cue to open up the trading journal and record it. You make a buy or sell, you open up the trading journal and record it. I'll tell you, it's an easy habit for some folks not to do. Very easy, just put on that trade and say, I'm good. But you lose the advantage of all that tracking, all that learning. Corey, thank you for the work in putting the journal together, the know-how, the time. It's certainly going to save us a lot of time. And so thank you for that. And I'm sure people
happy to do it.
Fantastic. Great job, Corey.
Thanks. Great job, everyone.
Okay, there we go.